Going over IRS Form 6781, gains and losses from Section 1256 contracts and straddles. So this is a tax form that you might need to complete and attach to your tax return if you have gains or losses from either Section 1256 contracts or what are known as straddles. And before we get into this one-page tax form, we're going to discuss a little bit about what each of those definitions means. So Section 1256 contracts are generally any of the following: a regulated futures contract, a foreign currency contract, non-equity options, dealer equity options, or dealer securities future contracts. So they don't include any securities future contracts. They don't include options on a securities future contract, interest rate swaps, currency swaps, basis swaps, commodity swaps, equity index swaps, credit default swaps, interest rate caps, or interest rate floors. So generally speaking, you're not going to find yourself in a position where you accidentally didn't file this form. You either know that you have what's known as a mixed straddle or a Section 1256 contract, or you don't. A straddle means offsetting positions with respect to property that's being traded. And we'll get into a little bit more detail about what exactly that means for straddles. So, as we go through each of the parts, it'll become a little bit more clear. So part one contains the Section 1256 contracts marked to market. In part two, we're going to go over gains and loss from straddles. Section A of part two has to do with losses from straddles. Section B has to do with gains from straddles. And then part three, we're going to note unrecognized gains from positions that were held on the last day of the tax year. So, one page, pretty, I wouldn't say straightforward, but it is straightforward if you're familiar with the terms and what exactly you're reporting. So, if this is a situation that applies to you and this is your first time, this might be very well worth hiring an accountant, like a CPA or an enrolled agent, to prepare your tax return for that year, and then circle back to explain to you, what goes into the Form 6781 to report those gains and losses. So let's go ahead and start at the top of this form. We're going to kind of go through our fictional heroes example, and we're going to first talk about all the applicable boxes that you might check. So, box A, mixed straddle election. So under Internal Revenue Code Section 1256D, you can elect to have the mark-to-market rules not apply to Section 1256 contracts that are part of a mixed straddle. And a mixed straddle is one in which at least one, but not all of the positions is a Section 1256 contract. So under Section 1256 rules, you normally have to categorize a certain percentage of capital gains as short-term, certain percentage of capital losses or gains as long-term. That's the mark-to-market rules. So if you have a mixed straddle election, you can choose not to make that election or not to have the mark-to-market rules apply. So if you do make that election, it applies for all later years, and you cannot revoke that election without IRS consent. So if you've previously made the election, or if you're choosing to make it, then you would check box 1, and then any Section 1256 contracts goes into part 2 instead of in part 1. That's what that means. Box C is a straddle by straddle identification election. So you would use this election for mixed straddles by clearly identifying each position by the earlier of either the close of the day in which you identify the mixed straddle or the time that the position is disposed of. So the earlier of those. You cannot make a straddle by straddle identification election for any straddle in which a mixed straddle election was made, or if one or more straddles positions are included in a mixed straddle account. So if you've previously made this election, or you're going to make this election, then any positions that you held on the day before that election, they're deemed to be sold at their fair market value at the close of the last business day. So each year that you hold positions subject to this election, you have to mark to market your Section 1256 contracts and then determine whether you have a net gain or a loss. And if that net gain or loss is due to a net non-Section 1256 position, then the net gain or loss is treated as either short-term capital gain or loss. You would enter that directly onto IRS Form 8949, and then you would identify the election from there. If the net gain or loss is attributable to the Section 1256 position, you would enter that on Part 1, you identify the election, and then proceed accordingly. Box C is if you have a mixed straddle account election, and you would make this election to establish one or more mixed straddle accounts for the following tax year by the due date of this tax year. So this is the most recent version of this form, 2024. We're recording in 2025, but the 2025 forms have not come out yet. So in this case, if you were using this form, you would be doing this by the due date of your 2024 return for 2025 tax year. So in this case, you would check box C, you would attach this to your return, you would then report the annual account net gain or loss from a mixed straddle account in Part 2, and then you identify the election. In box D, you are if you have a net Section 1256 contracts loss for the tax year, you can elect it to carry it back up to 3 years. And so that's what this is. You can do this only if you're not a corporation, estate, or a trust. And your net 1256 contracts loss is the smaller of the excess of your losses from Section 1256 contracts over the gain plus $3,000 or $1,500 if you're married filing separately. Or the total that you would calculate as your short-term and long-term capital loss carryover if line 6 of this form were 0. So you would need to use a separate Schedule D and a capital loss carryover worksheet to go through that calculation and make that determination. So that's the smaller of your loss that you can carry back. So the amount that you can carry back to any prior year is, again, this time it's the smaller of any gain that you would report on line 16 for that year's Schedule D. If only gains and losses from Section 1256 contracts are accounted for, or the gain, if any, reported on line 12 of that year's section or Schedule D. So either you have to calculate the Schedule D with the Section 1256 contracts incorporated into it, and then you have to do a separate calculation for Schedule D as if those contracts were not included, and then you're able to use your loss carryback against the smaller of those two gains. And if you don't have a gain in that year, you have to find another applicable tax year. So if you're using this, you would check box D, you would enter the amount of your loss that's carried back, and then you would enter that as a positive number. So what we're going to do is we're not going to make any of these elections. If we had made an election, we would have to go down those specific rules. You don't have to make an election for A, B, C. And if we don't have a Section 1256 contracts loss, you don't have to make an election for in box D. So what we're going to do is we're simply going to complete the form as if we're doing it for the first time. So let's just say that the identification of the account in part 1 is ABC Holdings. Again, we're being very vague on the details because we're simply working through the mechanics of this form. So let's say that there's a $5,000 loss here, and then DEF Holdings, we have a $10,000 gain. So now in line 2, we would net the $5,000 loss against the $10,000 gain, and we get a gain of $5,000, right? So if we had multiple of these, we would be adding all of these up before we add them left to right. Now in line 4, we're talking about adjustments from Form 1099B. So if the 1099B that you received includes a straddle or a hedging position, a transaction, then you may need to make certain adjustments. And you would attach a statement listing each of those adjustments as what you would attach it to your Form 6781. Then you would put the total in line 4. So you would need to make an adjustment for the following: the Section 1256 part of a the contract part of a mixed straddle, if you made any of the mixed straddle elections, the amount of the loss if you did not make any mixed straddle elections, or if the straddle was not identified as a mix and you had a loss on the Section 1256 contract part less than the unrecognized gain. So if the unrecognized gain is less than the loss, you would enter that gain. You would use part 1 for a loss on the disposition of one or more positions that are part of the mixed straddle that are non-Section 1256. If no disposition of a non-1256 position would be a long-term capital gain or loss, and if the disposition of one or more Section 1256 positions would be a capital gain or loss. And then you also need to make any adjustments for the Section 1256 contract part of a hedging transaction. So you can find a lot more detail if you need to in publication 550. We also do cover these step by step in the form instructions. For simplicity's sake, we're going to say that there were no Form 1099B adjustments. So we net these lines together. So now if line 5 shows us net gain, we can skip line 6. Again, this would be, line 6 is what we would enter if we needed to. Let's see. So if you're a partnership, you would enter the amount from line 5 on your K1 line, your Form 1065 Schedule K, line 11, not K1s. It would get distributed eventually through a K1. S corporations enter the line 5 amount on 1120S, Schedule K, line 10. So these lines do not apply to partnerships or S corporations, so you would leave them blank. Since John Doe is neither a partnership nor an S corporation, we're going to continue. But we can skip over line 6. And since we're skipping over line 6, we're going to carry down the line 5 amount to line 7. Now, in this case, if you're not deferring any of this gain due to an investment in a qualified opportunity fund, a QOF, then you would enter this gain on line 4 of your Schedule D, and then you would enter the line 9 amount on line 11 of Schedule D, or if you need a complete Form 8949, you would enter this in Part 1 and the long-term capital gain or loss in Part 2 of your Form 8949. So 40% is a $2,000 gain. 60% is a $3,000 gain. And that's how you would do this. And then you would need to make those adjustments year after year. So this could be the same contract the following year. You could be realizing gains and losses in the opposite direction. So in part 2, we've got 2 sections, section A, section B. So section A, you're going to use this to describe any losses from positions that are part of a straddle. And generally, a loss is allowed to the extent that it exceeds the unrecognized gain on offsetting positions. Part of the loss that's not allowed is treated as if it was incurred in the following year, and it's allowed to the same extent. However, a loss from a position established in an identified straddle after October 21st, 2004 is not allowed. Instead, the basis of each offsetting position that has an unrecognized gain is increased by the amount of the unallowed loss. And there's a formula by which you could calculate that basis increase. Section B, you're going to use that to calculate gains, but you would not include any of the following in part 2. Don't include a position that's part of a hedge. Don't include a loss position that you established before October 22nd, 2004, unless you disposed of all the positions making up that straddle. Do not include a loss position in an identified straddle established after October 21st, 2004, and do not identify any positions that are part of a straddle if all of them are Section 1256 contracts. Again, mixed straddles you can enter here, but if it's all Section 1256, then it all has to be up here. So let's just say we have one property with, or one straddle position with a loss, one with a gain. So if we were on DEF Holdings, now we are on GHI Holdings, and then we'll just say that this is JKL Holdings. So let's say that we entered into this. We're just gonna pretend that this 2024 form is actually done for the 2025 tax year. So let's just say that we disposed of this in 2025, and this is the actual 2025 tax year. So let's say we sold it for $10,000. Our basis was $5,000. Now, if you need additional detail about what constitutes adjustments to basis, things of that nature, you can find more detail in publication 550. Column F, if column D is more than D, or if column E is more than D, you would enter the difference. That would be a loss. This is technically not a loss. So if column G would be the unrecognized gain on all of those. So if we had an unrecognized gain on any offsetting positions, oops, sorry. I forgot that section A is for losses, so I need to actually calculate this as if we're generating a loss. So I switched these around. We actually sold this position at a loss. This cost us $10,000. We ended up generating $5,000 of sales, so the loss is $5,000. I'll go through the opposite example in section B. So now if we had an offsetting position, we would have to enter the unrecognized gain. So that means we're going to subtract the unrecognized gain from this loss, and this is the loss that we have from the straddle. Now, if we would take the short-term portion of these losses from line 10, put them here, and on line 4 of your Schedule D. So this does not have the 40%, 60% rule that you see in the Section 1256 contracts. That's literally the section of the Internal Revenue Code that tells you how to categorize short-term, long-term gains and losses. In this section, it's literally either short-term or long-term. So in this case, this would be 0, and then this would be the $3,000 loss. That would go on line 11 of Schedule D because this was a long-term transaction as evidenced here. So we're going to, now if we had, let's say we had a short-term loss. So I'm going to use the exact same numbers here because since the sum of this is going into a different box. This is clearly a short-term transaction, so we would put that in this field right here. So that's what that would look like. $3,000 of short-term loss and then $3,000 of long-term loss. Short-term goes on line 4 of Schedule D, or it would also, if you had to enter it on IRS Form 8949, that would go in Part 1 with box C checked. And then you would enter Form 6781, Part 2 on line 1. If you're entering this long-term figure, that goes in Part 2 with box F checked. Enter Form 6781, Part 2 on the line 1. I did neglect to mention that these transactions, if you're putting them on IRS Form 8949, you should at least annotate where they came from. So Form 6781, either Part 1 for any transactions up here, Part 2 for transactions down here. So now we're on M&O Holdings. M&O. All right, so let's just say that we had a gain. It was we're gonna just call it a long-term gain. So 1/1/2023, and we're gonna flip the numbers. So now this is a $5,000 gain. Since this was clearly a long-term gain, we would have 0 short-term gains, and we would have $5,000 that we enter. And again, this would be, so these are on line 4 and line 11 of Schedule D, respectively. Same thing here, line 4, line 11 of Schedule D. And then your Form 8949, you would enter that on either Part 1 or Part 2. So now if you're, you may have different rules if you're deferring this amount as part of a qualified opportunity fund investment. You can do that. Basically, you would have to follow additional instructions to determine exactly what would qualify as a QOF investment. But you can, under the tax rules, you can defer a certain amount of this based on the fact that you're going into a qualified opportunity fund, a specialized investment. You can use that to defer your gain. Part 3 is where you're going to list each position, whether or not it's a straddle, that you held at the end of the tax year, if the fair market value at the time exceeds your cost or other basis as adjusted. So this would include any position where you're holding because it's being held by a related party. So if the constructive receipt of that gain would be to you, then it would come here on your Part 3. So don't complete Part 3 if you don't have a recognized loss on any position. Don't include positions that are part of an identified straddle or a hedging transaction. property that's stock and trade or inventory, or property that's subject to depreciation. So you're literally just describing any remaining holdings that you haven't recognized a gain for. So let's just say that this is PDQ holdings, and you've had this since 2023 as well, and the fair market value is this, your cost basis is that, your unrecognized gain is $10,000. So there's not really anything you need to do. You don't carry it to another part of your tax return. It's simply there to carry forward to the next year. So that's about all I have for this video. Not a lot has changed since the first video, but the form has been updated just basically by updating the year at the top right corner. Other than that, most of it's pretty structurally the same. I did want to make sure that we kind of updated this video along with the article that we recently published. So if you need to get more information, you can certainly check out the article. If you go to, there's a link in the show notes, or you can go to teachmepersonalfinance.com, type in IRS Form 6781, and the article should appear. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.